Hello friends, hope you are doing good. In this video session, we will be discussing the GE9 Cell McKinsey Matrix, yet another portfolio analysis strategic tool. GE9 Cell is a portfolio analysis tool developed by McKinsey for General Electric Company to do their business portfolio analysis. This tool is developed to overcome the limitations of BCG Matrix. A company with many business units or divisions can effectively use GE9 Cell Matrix for strategic decision making on investment priorities. Let us understand how GE9 Cell Matrix is prepared and used for business portfolio analysis. If you have understood BCG Matrix and its application for decision making, here you just need to understand the difference between GE9 Cell and BCG Matrix, and that should help you to explain and apply GE9 Cell Matrix for business portfolio analysis and decisions on investment priorities for the business organizations along with management of the business. That means this tool is not only helping organizations to understand the investment priorities, but it will also help organizations to understand how to manage their businesses. That is, the GE9 Cell strategic tool will help organizations to understand and to decide on which businesses to invest in, which businesses are needed to protect, and which businesses are needed to harvest or divest. It can be also used by a company having limited products like say Apple Inc., but which operates into different countries. Such companies can also make use of GE9 Cell Matrix to decide on investment priorities to maximize their return on investment and profitability. So let us understand it in a simplified way. In my previous video session, we discussed BCG Matrix and how it is used for business portfolio analysis. We also understood that for a company, the portfolio means its product, services, segments, assets, etc., on which the company is investing with the objective to manage their earnings, maximize their ROI, and to earn as much possible profits. BCG Matrix is plotted against the market growth rate on y-axis and relative market share on x-axis. That's why BCG Matrix is also known as growth share matrix. How to calculate market growth rate and how to calculate the relative market share is already discussed in that video of BCG Matrix. BCG Matrix evaluates performance of the products or services against two score levels, high and low, which is considered to be the limitation of BCG Matrix, and hence GE9 Cell Matrix is developed by McKinsey. The link for BCG Matrix video session is mentioned in the description for your reference. Let us understand what is GE9 Cell Matrix. So it is the strategic tool used for business portfolio analysis. GE9 Cell Matrix is a strategic planning tool used by the businesses to prioritize investment in different businesses units or products based on their growth potential and competitive strength. It was developed by McKinsey and Company for General Electric in 1970s to help General Electric to manage its diverse business portfolio. GE9 Cell is a 3x3 matrix which is plotted against business strength, that is competitive strength, and the industry attractiveness. Unlike BCG Matrix, GE9 Cell Matrix is plotted against three levels of weighted average score as high, medium, low for better understanding of business units or segments or the products for better decision making on investment priorities. Let us understand how GE9 Cell Matrix is different from the BCG Matrix. The first and the basic difference is in its complexity and structure. BCG Matrix is simple 2x2 cell matrix with 4 quadrants which are named as stars, cash cows, question marks, and dog quadrant. Whereas GE9 Cell Matrix is more complex 3x3 cell, that is 9 cell matrix, allowing for a finer level of detail with 3 strategic zones: grow, hold, and harvest. BCG Matrix is plotted against 2 weighted average score levels which are high and low, while GE9 Cell Matrix considered 3 weighted average scores levels which are high, medium, and low. Simplicity of BCG Matrix is beneficial for the companies with straightforward, simple portfolios, but it might not be useful for the complex businesses. While GE9 Cell Matrix offers more flexibility with 9 cells and more criteria, allowing businesses to make varied decisions on a broader range of strategic options. Based on its applicability, BCG Matrix is more effective for single business portfolio or those with smaller number of products, while GE9 Cell Matrix is designed for large, decentralized, conglomerate, diversified companies like GE itself, Reliance, Tata's, etc., providing a more detailed framework for managing complex and multi-industry portfolios. And the criteria dimensions used in BCG Matrix, which evaluates product or services units based on the market growth rate for potential and market share for current performance, while GE9 Cell Matrix considers industry attractiveness, which includes factors like profitability, growth rate, competitive dynamics, etc., and business unit strength, which includes factors like brand strength, customer loyalty, market share, etc., which we will be discussing in the next slide. As we discussed, unlike BCG Matrix, GE9 Cell Matrix is plotted against industry attractiveness, which shows the potential for the growth of business segment or the product against the business strength, that is the competitive position of the organization. McKinsey defended by saying that only market growth rate will not guarantee the performance of any business or product, but the businesses must have the competitive strength so that they can compete with the competitors and earn maximum ROI. On y-axis we have industry attractiveness, that is whether the industry environment is favorable or unfavorable for investment. There are various factors which will make industry favorable for the investment, such as the size of market. The greater the size of market, the larger will be the customer, and hence it will have a potential for growth. Thus, companies can decide to invest into such markets where the potential for growth is more. Any industry where the competition is low and the profit margin is high is said to be attractive industry. We have already discussed pestle analysis and Porter's 5 forces model of competition to understand the attractiveness of industry. All those factors from Porter's and pestle analysis you can discuss individually or collectively here to find out whether the industry is attractive, that is favorable, or not favorable for investment. The link for Porter's model and pestle analysis is also given in the description for your reference. On x-axis there is a business strength which a business must have based on their 5M resources and competencies, which will allow organizations to develop competitive advantage and thus will help organizations to beat the competitors and accomplish their goals and objectives. The competitive strength include the market share, that is if any company is having larger market share will become the market leader and can control the market and strategic decisions, like Reliance Jio after its entry in telecom sector became the leader and controlled the prices of services. If a company has designed their value chain activities in such a way as to achieve economies of scale and is able to differentiate their products, can earn more profits and can become financially even more capable company to expand its business and threaten the competitors. This will help organizations to increase a loyal customer base as they can provide higher quality products or services and at the lower prices for their customers. This will make the company capable of beating the competition and earning maximum ROI, which will further help organizations to build a positive brand image in the market for sustainable competitive advantage. That is, to have a business strength or a competitive strength, the company should work on all these factors which are helping organizations to develop the competitive advantage and the other factors which are outside of the company which are related to the industry attractiveness. So all these factors are considered while plotting GE9 Cell. So now if you look at the GE9 Cell Matrix, which is plotted against the business strength on x-axis and industry attractiveness on y-axis with 3 levels of weighted average scores as high, medium and low. It is a 3 by 3 matrix, that is a 9 cell matrix which can be colored centrally or diagonally yellow. Above the diagonal line 3 cells with green color and below the diagonal lines 3 cells are colored with red, where the green color indicates the favorable environment for investment. Yellow indicates the cautious decision making to protect the businesses, while the red colored cells indicates either to harvest, that is lowering the investment and earning the profits, or divest if more losses are produced. The decisions written in each of the cell are based on the industry attractiveness, which can be high, medium or low. Similarly, depending upon the business or competitive strength, which also can be high, medium or low. If you look at the uppermost left hand side quadrant, which is in green color and against high industry attractiveness and high business strength, means this is the most favorable condition for the business to invest and maximize their earnings. If you look at the right hand side lowermost quadrant, which is in red color, which is against the low industry attractiveness and low business strength, means here the company should think for divestment decisions. Likewise, you can explain each of the quadrant or cell of GE9 Cell Matrix, and based on that the business decisions on investment priorities can be taken by a large conglomerate companies. So as we said, if the business or the SBUs they are falling on the diagonal yellow color quadrant, then the organization should go for selectivity or managing their earnings. If the businesses or SBUs are falling on the green quadrant above the diagonal line, then the company should invest into build and grow strategies. And if the businesses are falling in the red quadrants or red zones, then the organization should try to lower their investment and harvest, or they should try to divest their businesses. When we will be placing the SBUs, that is the businesses or products of any large conglomerate organization, it will be positioned in respective quadrants based on the industry attractiveness and business strength as analyzed by the organization. The only difference which we must consider is that depending upon the size of the market, the size of circle, that is the size of SBU will vary. The larger the size of market, the larger will be the circle size, and within that circle what is our organization's market share, it will be also shown therein. Here for our understanding, I have mentioned three different sizes of circles which indicates three strategic business units. The first strategic business unit is in a large market size, and hence it is shown with a large circle as compared to the other two circles, and in that market our business has 30% of the total market share. The second circle is smaller than the SBU1, where our market share is 50%, and the third SBU, where the circle size is small, where the competitors market share is 85% and our market share is 15%, as well as the market size also is very small. In the case of BCG Matrix, there is no need for such different sizes of circles. There you can directly mention the name of the product or probably the circles and mentioning product number 1, 2, 3 likewise. Here you can mention which SBU should receive more investment and why in the comment box, which will help me understand that you understood what is the sizes of circle means, that is the SBU, and how it will help us to decide on investment priorities. Here if you can find, depending upon which quadrant the SBU is positioned, you can take the appropriate strategic decisions so that there should be less of losses to the company and more will be the earnings to the business organizations. If we look at the three color codes which are like that of the traffic signal lights, hence it is also called as stop light strategy matrix, where red color indicates danger, risk means stop, yellow color light indicates to be cautious, and green color light indicates a safe zone and we should proceed further. Similarly, the SBUs which are falling on these three color codes help organizations to take the decisions on investment priorities. If the product or SBU is falling in the red zone, means the businesses should think for harvest or divest decision, indicating retrenchment strategies like divestment and liquidation, or a rebuilding approach for adopting turnaround strategies. The yellow color zone indicates the cautious approach for selectivity or managing the earnings, indicating to wait, see and proceed, hold and suggesting maintain type of strategies aiming at stability and consolidation. While for the businesses which are falling in the green zone, it indicates to build or grow, which attracts major investments and adaptation of growth strategies. I hope You have understood how GE9 Cell Matrix is different from the BCG Matrix and how GE9 Cell is used for SBU analysis and taking strategic decisions on which SBU should receive maximum investment and which SBUs should receive minimum investment and how to manage their earnings. In our next video session, we will begin with the second stage of strategic management process, that is strategy formulation, and in that we will begin with the business level strategies, which are also called as generic strategies or competitive strategies. So stay connected. Thank you.